a taxpayer purchased a house in a place called Anna Bay, which is north of Sydney. And this particular house was purchased in 2006, and it was a house that was right on the beachfront, not all that far from Sydney. The person thought, great, I'll buy this house and I'll be able to get pretty good rentals from it for holidaymakers and so forth. So the person borrowed money, so they got mortgage interest on it, and they've got other deductions, as you'd expect, land tax and council rates and so on. So that's what happened. But unfortunately, the property was not rented out anywhere near as much as what the person would like. So then what the taxpayer did is that they put in a full-time tenant from 2010 through to 2012. And so that full-time tenant lived there. Now, the reading of the case is that the house continued to be run down, and I think that the full-time tenant basically got sick of living in a rundown house and said, I'm off. Now, what happened at that point was that the house became vacant and uninhabitable for this period here. And so during this period, 2012 to 2017, the taxpayer continued to claim tax deductions for all of the interest and the land tax and so forth, all the way through to the 2017 year, when the tax office said, that's enough. We're not giving you a deduction in the 2017 year. So in the 2017 year, the tax office denied the deductions, and that's what we have the dispute over. Some other facts I'll just tell you is that during this period, 2012 to 2017, the taxpayer did have the building inspected by an architect who was a cousin. I'm not sure that he charged anything for it, but he did, and gave some views about what he wanted. An electrician who was also a relative checked out the wiring, and the person engaged somebody to draw up a proposed development, which was going to cost about $800,000, and did have that project approved by the council. Also, a couple of other things that happened in this time was the taxpayer's father had a stroke around about sort of 2013, 14. And what happened was the taxpayer then visited the father every day for a whole year. Then a bit later, in around the 2016 time, the taxpayer's business interests got into some degree of difficulty. And in fact, it finished up that the taxpayer basically became redundant from the business that he was working in. Now, his view was that all of that with his father and his business and so forth delayed the development of the project. But what we have here is the fact that during this period here, the property was vacant and uninhabitable, and he was claiming tax deductions.
We've got a poll. Naturally. So would you have claimed tax deductions for the rental property while it was vacant and uninhabitable? So get involved, people. What do you think? Shall we see the answer? What people would have done in this case? No. Would not have claimed deductions.
Right. Now, this is a very interesting point. And I've now asked this question of a few accountants and accountants firm, and I get exactly the same result, almost the same percentage.
Oh.
Yes. And unfortunately, folks, you're not right.
Too conservative?
Yes. So now the reason why you're not right is important to understand, because what's happening is that you're focusing on the wrong issue under Section 8-1. Okay. So now there were actually two members of the AAT on this, so that indicates it was a difficult decision, and they allowed the deduction. So they said the taxpayer was still committed to deriving income from the property. So just at the end of the case, the AAT says this: we accept the delay in execution of the project could become untenable at some point. At such a point, the taxpayer would no longer be said to be incurring outgoings in gaining or producing assessable income. but the taxpayer had not reached that point in the 2017 year of income. Whether he would succeed in making the same argument in subsequent years of income remains to be seen. So what they're saying is, well, on the evidence, we'll say he's still got his deduction of 2017, but following years, we're not prepared to say that at the moment. So let me just explain the technical point here. Under 8-1, what we are asking ourselves is whether when we are incurring an amount, let's just focus on the interest for the moment, is that being incurred for the purpose of deriving assessable income? Now, it's a well-established principle of Australian tax law that the outgoing and the derivation of income don't have to coincide in the same year. So when we're talking about the deductibility of interest, the key question is, when we first borrowed the money, why did we do that? Well, we did it to buy property to derive rent. Now, the question is, has that, some years later, has that purpose changed? We're still incurring interest, and are we doing that for the purpose of deriving assessable income? Don't be confused with the point of whether we are deriving assessable income. The question is it being incurred for that purpose? And if the answer to that is yes, then you claim the deduction. Now, you can't, of course, go forever. I mean, if we were 50 years down the track and the guy still hasn't got any rent, of course, you get to the point where you break the nexus. And that's the point and the part of what's being said in this quote below. But take, for example, if you had a rental property and you decided that you wanted to do some renovations. So let's say the current tenant leaves the property, their lease is finished, and you say, okay, 3 months, we're going to, knock down some walls and do some things, and it becomes unavailable for rent during that time. That does not mean that your deductions become disallowable, because the question is, are you incurring your outgoings for the purpose of deriving assessable income? The fact that you're not currently deriving assessable income is not to the point, although the tax office might like to make that point, but that's not to the point. It's a well-established principle that you can incur outgoings and still be deductible, even though you're not deriving assessable income. So that point, I think, Joyce, is just to be noted, because the reaction that I've got, that we got in that poll, is exactly the same reaction I've got from just about everybody else I've spoken to about this. About 70% would never have claimed the deduction. What they would have done is added it to the cost base. And yes, it's more conservative, I get that. But this case stands for the principle, and I believe the correct principle, that it is deductible.
Yes, I think the chat is blowing up. So very
Yes.
good topic today. I think there is a sort of misconception of a rule of thumb, which says something like you can only claim a deduction on a rental property if it's available for rent. And then you would deduce that it has to be inhabitable, which is not quite a right rule of thumb.